Hello guys, in a surprising turn of events, the U.S. economy, the largest in the world, contracted by 0.5% in the first quarter of 2025. This marks the first time in 3 years that America's economy has shrunk rather than grown, triggering concerns both domestically and globally about the impact of trade policy, consumer confidence, and broader economic momentum. The data, released by the U.S. Commerce Department, also represents a significant downward revision from its previous estimate, which had placed the contraction at just 0.2%. Economists had actually forecast no change at all. This unexpected decline is a signal that headwinds facing the global economy are becoming harder to ignore. While the number, a 0.5% annual decline, might seem modest, the details behind it are both revealing and worrying. Let's break it down. One of the biggest contributors to the decline was a massive increase in imports, which jumped around 38% during the January-March period, the sharpest increase since the early COVID-19 recovery in 2020. This was not a sign of booming demand, but rather a rush by businesses and consumers to buy foreign goods before new tariffs took effect. President Donald Trump's renewed push for trade protectionism, especially heavy tariffs on Chinese, European, and Mexican goods, led to panic buying. But in GDP accounting, imports are subtracted from GDP. That's because the measure only accounts for domestic production. So when imports surge, GDP falls, even if Americans are spending more. This technical factor alone dragged GDP down by nearly 4.7 percentage points, erasing gains in other areas. After contributing strongly to growth at the end of 2024, consumer spending slowed sharply, rising only 0.5% in quarter one compared to a robust 4% increase in the previous quarter. This is a red flag for economists because consumer spending drives over 2/3 of U.S. economic output. The slowdown appears linked to rising economic anxiety, with many Americans concerned about the impact of tariffs on everyday goods, from electronics and clothing to groceries and travel. Claudia Sahm, former Federal Reserve economist, remarked, "The downward revision to consumer spending today is a potential red flag. Spending cuts on recreation services and foreign travel suggest a level of pessimism that we can't ignore." Another surprising contributor to the GDP drop was a 4.6% fall in federal government spending, the steepest since 2022. This decline, likely due to budget tightening and delayed infrastructure disbursements, added further downward pressure. Additionally, the U.S. dollar has hit a 3-year low, declining nearly 10% in just 1 year. This is being partly attributed to President Trump's repeated attacks on the Federal Reserve and his pressure to cut interest rates, actions that have led investors to question the independence of the U.S. central bank. President Trump wants immediate rate cuts to boost the economy, but the Fed has resisted political pressure. Reports suggest President Trump is now seeking Powell's replacement even before his term ends in May 2026. This has shaken investor confidence, leading to a further decline in the dollar index, which fell from 110 to 98. Analysts believe the credibility of the U.S. economy is under threat due to such political interference. The Financial Times and other global media outlets have noted that investor trust in the dollar is lower today than during the COVID-19 pandemic, a striking observation given the massive stimulus spending during that crisis. In simpler terms, if the U.S. economy was worth $100, it is now worth $99.50. This is not a minor dip, especially for a developed economy like the U.S. A second consecutive quarter of contraction could officially push the U.S. into a recession. The economic data aligns with what Americans are feeling. According to the Conference Board, U.S. consumer confidence in June fell to 93, down from 98.4 in May. More worrying was the Expectations Index, which measures how optimistic people feel about the near future, including job prospects and income. It dropped to 69, well below the critical threshold of 80, which economists often use as an early warning sign of recession risk. Amid the gloomy headlines, there were a few bright spots. A measure known as core GDP, which strips out volatile components like trade, inventories, and government spending, grew to 1.9%. While slower than the 2.9% recorded in Q4 2024, this shows that private domestic demand from businesses and households hasn't collapsed. Moreover, the import surge is widely expected to be a one-time event. Since the bulk buying was front-loaded in the first quarter, it's unlikely to repeat in the second. This opens the door for a potential rebound. In fact, a FactSet survey of economists projects that GDP will grow at around 3% in the April-June quarter. If that happens, it would signal that the U.S. economy remains fundamentally strong despite short-term disruptions. The first official estimate of second quarter GDP will be released on July 30th. Why should the rest of the world care about a dip in U.S. GDP? The U.S. accounts for about 25% of global economic output, and its slowdown can have ripple effects worldwide. Export-heavy economies could see reduced demand from American buyers. Commodity prices, especially oil and metals, could become volatile. Foreign investment flows may slow down, especially in emerging markets. Currency fluctuations could impact countries with large import bills. The first quarter contraction in the U.S. economy serves as a warning sign about the broader consequences of aggressive trade policy and weakening consumer confidence. While it's too early to call this the start of a recession, the data reflects how economic sentiment, political decisions, and market behavior are deeply interconnected. A single quarter doesn't define a trend, but it does offer insight into where things might be heading. Also, the one big, beautiful bill is still to come, along with the additional tariffs that President Trump announced on Liberation Day. So the world will be watching closely when the second quarter data is released in late July. Until then, policymakers, investors, and ordinary citizens alike will have to navigate an uncertain economic landscape.